So I think we'll get started. Thank you everybody for joining in. I'm sure more people will trickle in. This webinar will be recorded as well, so if you have to leave in the middle of it or if you weren't able to catch it live, we'll have this archived on our website along with the PowerPoint slide deck, and then we have a preliminary forgiveness worksheet based on the latest. Based on the loan application, the forgiveness loan application, then we'll also have that available for download too. So welcome, thank you everybody for joining in. I know this program's constantly evolving. It's like every day we're getting a new set of guidance. You know, it's every day there's a new FAQ, there's a new interim final rule. There's something superseding the thing from the day before that gets superseded the day after. We had everything with the certification issue as far as whether or not you could certify that it was actually appropriate for you to get the loan. We're kind of making it over that hump. We're going to touch on that a bit. May 18th today is the last day that you can return the PPP funds without any type of penalties. So far, they haven't extended that date at all. So hopefully this webinar will serve to, you get to get a preview of the forgiveness, touch on the certification. Then if for any reason you decide you do have to return it today, you still have time to do so. Just a disclaimer, it's not intended to be tax or legal advice. Basically, we've got the information in here on the forgiveness. Just reach out to us. Every business situation is different, so there's no blanket way to handle this. This will apply to different industries, but we can definitely take a look. We do have the Q&A feature is, I believe, at the bottom of your screen on Zoom. If you want to save those, you can send them throughout. I'll probably take a look at that Q&A at the end of the session. Any of those that we aren't able to get to during this, definitely feel free to reach out to myself or one of the other. I'll have some other contacts listed, and you can shoot us your questions, and we can look into those too. So topics, we're just going to go through just a brief touch on the PPP overview of the program itself. Most of the people here probably either have a PPP loan at this point or you have an application pending. Again, touch on the certification because today's the 18th. Then we'll dive into the loan forgiveness. That's the bulk of this. That's where a few new areas, some clarifications, probably some new questions have come up from the actual application when that came out last Friday. Some possible future changes. We are expecting still there's going to be some type of interim final rule or regulation on forgiveness to accompany this application. It almost seems a little backwards that they put out the application before the interim final rule, which suggests that, maybe there won't be that much to clarify from that new piece of guidance, but we'll have to wait and see whether it comes in FAQs or interim rules. There is additional guidance to come. I know you're probably sick of hearing, we aren't positive on that answer yet, looking for the next piece of guidance. Unfortunately, the way this program has been rolling out, it has been kind of piecemeal with a little bit each time. Along with that, on possible future changes, we had the HEROES Act, which passed through the House last week. I don't think that has any chance of getting through the Senate. Even if it did, it would get vetoed. That had some PPP changes that, maybe those will eventually make it into some type of bipartisan legislation. And then there's also some other bills pending on, the amount of weeks that you have. Instead of 8 weeks, maybe you can get 12 or 24. The deductibility of the expenses. We saw recently that any expenses you pay with forgiven loan amounts are non-deductible. But then we also saw members of Congress come out and say that wasn't the intent. And there's some letters and already a bill to change that. But all we can really do at this point is kind of advise on everything, the lay of the land as it is right now, and then catch on any guidance as it trickles out. We got a loan forgiveness application example that kind of works off our spreadsheet at the end, and then just some resources, some links, and email contacts you can reach out to us for. So touching on the overview, the PPP program came from the CARES Act, which passed at the end of March. Section 1102 had the PPP loans, and 1106 accompanied that with the forgiveness provisions. They were supposed to come out with regulations on the forgiveness within 30 days, which would have been the end of April. They haven't come out with that yet, so they are a little behind there. Again, we got the application, which is the closest thing to forgiveness guidance we have at this point. There was 349 billion of funding that ran out within a couple weeks. And then it was additional funds of about 300 billion was added at the end of April. Last I checked towards the end of last week, I think there were still some funds left. So I don't think the program has been fully depleted. Plus there are also borrowers that have been returning. They've been returning their loans as well. For lenders, it was the existing SBA lenders. You had the FDIC or other federally insured institutions, some fintech lenders. These are, PayPal, Cabbage, things like that. Borrowers, it could be businesses, partnerships, self-employed, 501c3s. There's some other a little bit more niche, like veteran organizations. When it came to applying for the loan, small business concern, the 500 employee count, alternative size standard, there were certain standards you had to meet as far as not having more than 500 employees, but then there were exceptions to that. If, for example, you're part of a franchise, or if you were in restaurant industry with a certain NAICS code, then those gave you exemptions from the affiliation rules. We won't really dig into that too much here because, again, is targeted more towards those that already have the loan. The loan conditions, it was pretty favorable, non-recourse, no fee, no guarantee, no collateral. And despite the, the kind of uproar over people taking the loan that maybe shouldn't have been, there was no requirement to obtain credit elsewhere, which is typical of an SBA loan otherwise. The loan terms that they went with were 2 years at 1% with a 6-month deferral. The bill allowed up to 10 years, I think up to 4%, but they went with the 2 years at 1%. That's another area where there's some pending legislation to maybe push out that 2-year repayment term. The maximum loan amount was average monthly payroll times 2.5. So if you had someone that paid 1.2 million in payroll costs in 19, divide that by 12, multiply by 2.5, that gave you 250,000. That was the max amount you could borrow. This is, again, allowed, the intent was to allow for 2 months of payroll plus that other 0.5 for the other, would account for items like utilities and mortgage interests and such. So to touch on the borrower certification, again, this was, the big piece of it was that this first bullet here, the current economic uncertainty makes the loan necessary to support your ongoing operations. When the bill first came out, it seemed like, there was economic uncertainty for everybody. Everybody was starting to shut down. People had to quarantine, social distancing. Whether it was you were directly impacted by closures or maybe your supplier or your customers, there was a big cut. And so it seemed like everybody would be eligible for this if they otherwise met the size requirements. However, we saw that once, some of the bigger, the Shake Shack or the Potbelly or the LA Lakers, when the public started to see some of these larger organizations getting the loans, even if they were carved out in the bill, there was kind of, a backlash from the public. To jump ahead a little bit, we started to see some commentary from officials, Marco Rubio, Steve Mnuchin on Twitter, really running with it. I mean, going as far as to say, they'll use subpoena power to identify anyone that false certification, and it was a real push to it was almost like it seemed like a fear campaign to stop the larger businesses that weren't supposed to take this from getting it. Along with that, we had the FAQ 31 and 37. 31 was targeted towards public large companies, saying that, if you had enough liquidity, if you were able to tap into public capital markets as well, then, you know, maybe you should reevaluate whether it's actually appropriate for you to take this loan. Additionally, we had question 37 came out right afterwards, which said that basically this question also applied to private companies. So after this, it was, you know, again, there was a bit of fear around, you know, am I going to get penalized for taking out this loan? I thought, you know, because of the economic uncertainty, I was in the right to do this. And now we're seeing all, you know, a rush to repay. Luckily, FAQ 46 came out, I believe on the 13th last week. And that one, it was kind of a change of course. So they kind of changed it to, if you're under $2 million for your loan, together with your affiliates, or if, you know, if the affiliate rule is waived, then you don't have to do the affiliation. But basically, if your loan was under the $2 million, then you get safe harbored. Meaning that you're automatically considered to have made the certification in good faith that you actually needed the loan. And additionally, they even went as far as to say that even those greater than 2 million, if the SBA comes and they review the loan, you know, they audit the loan, review it, whatever term they go with, and they find that, you know, you didn't meet this, there is some room where they may not pursue enforcement against you as long as you repay this. So this was kind of, you know, almost like a 180, where it went from everyone was scared to keep the loan to they're easing off. We'll see towards the end of the presentation as far as items that you should hold on to. Or keep in your records. One of the items they mentioned is documentation showing that due to economic conditions, it was appropriate for you to take the loan. So it doesn't hurt to at least, you know, take the time to think about whether you want to, you know, formally write down a document, for example. Just think about, you know, how has your industry been impacted? Again, how have your suppliers been impacted? How is, you know, maybe because of business shutdowns, none of your customers can come to your location, for example. Items like that, just to kind of justify and keep that in a file, just to back up you taking the loan. I think though, with FAQ 46, I think they largely kind of step back and they're saying, if you took a smaller loan, you know, you're pretty much good to go. Even if you took the larger loan, I mean, unless you are a large company, you know, I don't want to just stay strict to publicly traded, but a large company with a large amount of liquidity, it is a fact-based determination. So if you feel like you're on the fence, we can always, you know, review some details for your loan and let you know what we think. But to get into the actual forgiveness itself. So what we kind of knew going into the application was that the amount of loan forgiveness was the amount you incurred and paid during the 8 weeks following loan funding on payroll costs, utilities, mortgage interest, and rent and lease expense. There was also in the section 1102 of the CARES Act, you were allowed to pay interest on other pieces of debt. However, that wording was not included in the forgiveness section, the 1106 of the CARES Act. So as of now, as far as debt interest, it would just have to be on mortgage on real or personal property. And we'll get into, I'll show you the example of how broadly they define that. Also, we had, when the borrower application came out, we had the 75-25% rule, whereby you couldn't spend more than 25% of the amount forgiven on non-payroll costs. We got a slide on that to discuss that too. And then after you've determined your forgivable expenses from the top half here, then your forgiveness was subject to being reduced based on a reduction in your FTE, your full-time equivalent employees count, or a reduction in pay for one or more employees. So, and before I dig into that, just to give you a brief preview for anyone that hasn't already seen it, you know, here's a quick preview of the, and I'll probably bring this up throughout the presentation, but it's an 11-page. It's kind of jumbled with a mix of instructions, here's a form, here are the certifications, more instructions, another form, schedules, etc. It's a little bit mixed around. But we have this link as well in our constant contact, and I'm sure, just do a quick Google search and you can find that too. But to dig into the pieces of forgiveness, so starting from the top, 8 weeks. So they've clarified the 8-week period. So first, the default way to approach this is just the covered period, an 8-week period or 56 days beginning on the date of PPP loan disbursement. So we saw an FAQ on this a couple weeks back that said the day that you get that loan disbursed, your 8-week timer starts right then. Fortunately, through this application, one of the favorable new pieces was this alternative covered period. We'll see that this only really applies to the payroll costs and your FTE. So when you're looking to see the amount of utilities or mortgage interest, et cetera, you paid, you're going to be sticking with this top half, the covered period. However, for payroll and FTE, for borrowers with biweekly or more frequent pay periods, again, biweekly or more frequent are allowed to use this. You can use the 8-week or the 56-day period beginning on the first day of the first pay period following your PPP loan disbursement date. So this is really nice because it aligns, we've obviously had a good amount of borrowers that maybe you took out the loan in the disbursement date was in the middle of a pay period. This alternative covered period allows you to shift that and align your 8 weeks with your actual payroll periods if you have biweekly or more frequent. So that's a good relief. It kind of helps with so you don't have to do as much proration if you're eligible to do this alternative period. So again, for example, if you got the funds on the 20th, by default, your period would be the 20th through the 14th. That's a 56-day period. For the alternative period, let's say the first day, the first pay period was the 26th. Even though you got the funds on the 20th, you get to shift that under the alternative method, and you can use the 26th to the 20th. Again, another 56-day period. For borrowers that do elect to use this alternative period, you have to use it in all instances on the application where you may choose between one or the other. Meaning if you're determining your payroll costs on the alternative method, then when you go to do your FTE, you would also be using that same period. They just want to look for consistency. So on the payroll costs themselves, so I'm going to have this term cash compensation, and this follows, if you ever dig into the application itself, there's this column here, cash compensation. So they kind of break up the payroll costs. The first kind of bucket that you're looking into is this cash compensation. This includes your gross salary, wage, commission, other compensation, tips, leave, severance pay, etc. So the actual cash compensation, which does not include payments to independent contractors, sole proprietors, independent contractors, their loans are figured differently. Payroll costs also don't include the employer share payroll taxes, and it doesn't include any of the sick or family leave that's eligible for those FFCRA credits. So those are that was from the legislation that passed before the CARES Act that allowed employers to get a payroll tax credit for paying. It's usually either $511 or $200 of sick leave for the 2 weeks, and then up to 10 weeks of family leave at $200 capped. It's a bit outside the scope of the webinar here, but any of those leave wages paid, those don't get included as part of your forgivable costs. So the costs, so one of the items that we were also all waiting for clarification on was whether, it was amounts paid or incurred, or paid and incurred. It had paid and incurred during the 8-week period. What does that really mean? So luckily they clarified that it's payroll costs paid or incurred during the 8-week period, where they define paid as the date that the paycheck is paid or distributed, or the origination of an ACH transaction, and it's incurred on the day that the employee's pay is actually earned. So this means that if you have, the first payroll that's actually paid within your 8-week period, you get to include that full payroll because it's paid within the 8-week period. You get to include that as a forgivable cost. Likewise, they also have, if you have payroll costs that were incurred during, towards the end of your 8 weeks, but it hasn't been paid before the end of the 8 weeks, you get to include that cost in your forgivable expenses as long as it's paid on or before the next regular payroll date. So this kind of eliminates the need for a special payroll at the end. So if you have 3 days worth of payroll incurred towards the end of your period, you can still include those 3 days in your costs as long as you pay that during your first payroll after your 8 weeks ends. So again, this was another borrower friendly, giving a little bit more room for the borrowers. Cash compensation eligible for forgiveness may not exceed 15,385 or 100,000 annualized. So this is just that. So if you took 100,000, you divide that by 52 weeks, and then you take that across 8 weeks, that comes out to 15,385. So that's the max amount of forgiveness or max amount of compensation that you can take into account for forgiveness. We'll see that 15,385, that does not include like employer health insurance contributions or the retirement contributions. This is strictly that cash compensation measurement. One of the not favorable items that was included in this application, and this is not in the CARES Act, so we'll see if this does change at later times, but as it's written right now, the cash compensation for forgiveness for an owner employee may not exceed the 8-week equivalent of their compensation in 2019. So what this would mean is that if you were under that 100,000 in 2019 and you were drawing extra salary during your 8-week period as an owner in order to maximize your payroll costs, they're saying that you can't exceed whatever you had in 2019. So again, this is something new. This just came out with the Friday application that you have to cap the owner's compensation at the 2019 level, which kind of begs the question, as I have here, what about those that are related to owner employees? That was not addressed in the application. Maybe it'll be addressed in the guidance. If I were betting, I would say that they would look to apply the same rule to those related, but right now we don't have guidance either way on how that's handled. So then the other payroll costs. So we already looked at, again, the salary, tips, leave, and severance. So the other payroll costs, the employer contributions to health insurance, the employer contributions to retirement benefits, your state and local tax, which is generally going to be SUTA. Those are on a separate line of the application, and these are outside of the 15,385 cap. So if you paid, up to 15,385 in compensation for an employee, you get to include both that as well as the employer contributions for them allocated for the health insurance and retirement benefits. So these items, again, are not in that 15,385 cap. They're separate lines on the forgiveness application. For these items, just like the other cash compensation, you can determine these using either the covered period or the alternative covered period. Payroll costs. So the employees are separated into 3 kind of groups as I'm referencing, and let me pull up the application again for you. So without going through it might not jump out at you as having much weight, but your employees are either going to be listed on table 1, table 2, or there's a separate, if there's owner employees, more than one, then you would have to make another table. But compensation and FTE is all calculated on an employee and by employee basis. So when you're determining the amount of employees that go into either of these buckets, it does make a difference, because you can see the employees that make it into table 1 are subject to this salary or hourly wage reduction that can reduce your forgiveness, whereas those in table 2 don't have that. So to break out, who makes it into those. So that first table would be employees that receive compensation from the borrower at an annualized rate of less than or equal to 100,000 for all pay periods in 2019, or were not employed by the borrower. So this is coming right from the application. So borrow at an annualized rate of less than or equal to 100,000 for all pay periods in 2019. If you're reading it, I have the all highlighted and bold and underlined. This sounds like, does that mean that, no one single pay period, maybe someone got a bonus and that pushed them over $100,000 annualized for just that single week? Does that prevent them from being in this first bucket? Whether they're in one or two does make a difference. We'll get to that in a second. Similarly, the second table would be employees that receive compensation at an annualized rate of more than 100,000 for any pay period. So just like I was saying, does this mean we're looking at each individual check or each individual pay period throughout 2019, and once they hit something that would have been 100,000 annualized, then that pushes them into the second bucket? Or do you look at 2019 as a whole? It's kind of the way that they have the language is unclear, and really hoping that the guidance kind of clarifies that. It can be interpreted either way. It seems a little odd that, if you had someone that's making 80,000 as their salary, and because of, one bonus, 1 week, they got pushed over 100,000 annualized, that would make a difference. So I'd lean towards thinking that it's based on the entire 2019, but we kind of have to wait to see what they decide on that. And then the third bucket the third group would be owner employees, self-employed individuals, and general partners. So the reason that it matters so much whether employees fall into that first or second is because the application is taking the position, as it said in the CARES Act, word for word, and saying that if someone made over 100,000, then they are not subject to the salary or wage decrease reduction. So if someone had 110,000, then, if you drop their salary all the way down to 20,000 within the covered period, according to the application as it stands now, that would not create any issue for you as far as the salary wage reduction. I mean, you might not be spending enough payroll to get full forgiveness of all your costs, but it definitely makes a difference as to whether the employees fit in that first or second. We'll get into that salary wage reduction calculation in a moment, and it might jump out as to why it's so important after that too. So again, as I was saying, does this mean that any employee that received cash compensation for any weekly pay period exceeding 1923, which would be 100,000 annualized, is put in the group 2? If that's the case, then any decrease to their pay would not impact forgiveness amount. So this is that salary wage reduction that I was just talking about here. So to read it off, you have to reduce your forgiveness amount by the decrease in average annual salary or hourly wage of any single employee during the covered or alternative covered period, as compared to 1/120 to 3/31/20, which exceeds 25% prorated over an 8-week period. What does that mean? So you're looking at the annualized pay during the 8-week period versus the annualized pay during the first quarter of 2020. The CARES Act text mentioned the first full quarter, but the application comes out and explicitly says that you're using 1/120 to 3/31/20. We had some question as to whether or not you'd be able to use Q4 of 2019 as your comparative period. But again, the application just strictly sticks to that Q1 of 2020. So you look at your 8-week pay annualized, you look at your Q1 2020 annualized, and if you haven't cut that comparatively, if you haven't cut the pay by more than 25%, you can stop here. This reduction does not apply to the employee. Unfortunately, it is an employee by employee analysis. So if you have a large amount of employees and you've had a mix of some that you have and have not cut their salary, then you will have to look at this on an individual basis for those employees, which fall somewhere around that 25% cut. If you haven't cut anybody's pay, then this won't apply for those employees. You'll be able to skip this reduction. To kind of walk through an example of it, so say you have someone that during the 8-week covered period, you're paying them $50,000 annualized, versus during the first quarter of 2020, you pay them $80,000. First, you look at that decrease and you say, all right, from 80,000 down to 50,000, that was a 37.5% change. Okay, now I'm going to have a forgiveness adjustment. So you continue on and you look at 75% of the 80,000 was 60. You're paying them 50. That's a $10,000 difference. Divide that by 52 weeks and allocate it over your 8-week period. And that's 1,538. That would be the reduction to your forgiveness. So if you went and you calculated, here are all the expenses that I can have forgiven, you would then have to take that 1,538 and deduct that, reduce your forgivable expenses by that amount. However, they did come up with a very favorable read of the June 30th, 2020 salary wage reduction safe harbor. So the salary wage forgiveness reduction, this calculation that we just went through here, does not apply for any single employee if the safe harbor is satisfied. So what's the safe harbor? The safe harbor is the average annual salary or hourly wage of the employee decreases between the dates of February 15th to April 26th of 2020. If you're wondering, the April 26th is 30 days after the enactment. That's where they came up with that. So if there was a first, you'd have to have a decrease from February 15th to April 26th. And then second, the average annual salary or wage as of June 30th, 2020 is equal to or greater than the salary as of February 15th of 20. So what this means is, and it does seem to have a cliff effect here. So if you had someone where you cut their pay, say we'll go back to this example here. They were making 80,000, you ut their pay down to 50,000. As long as you restore their pay back to that 80,000 by June 30th, maybe within the pay period that covers June 30th, as long as you restore them back to that 80,000 by June 30th, the application finds that you are safe harbored from this reduction and that you won't take a hit. The implication here is that, putting all of that together, if you had someone that was previously reduced, you restore by June 30th to their February 15th levels, then there is no forgiveness reduction when it comes to the salary wage calculation. Now, with that, does it really make sense that, maybe you can cut someone's pay? Let's say you get the loan on April 10th. Your 8-week period actually falls before it ends before June 30th. Does it make sense that you can pay them a reduced salary for the entire 8 weeks, and then you wait till the end of June, you up their pay, and now you're good to go? We'll have to see if through any of the FAQs or the guidance, anything changes there. That's why we've been kind of hesitant to rely on the safe harbor. But the application is reading this way, that it's just a hard cliff effect of June 30th. It seems a little odd that you can rely on that, but again, as the application reads, as long as by June 30th, then you're good. So then the other component of reducing your forgiveness, remember, it's if you had any pay decrease or if you had any FTE decrease. So now looking at the FTEs. So they did finally define how to calculate FTEs. It's the average number of hours paid per week divided by 40 hours. I know there's obviously those that don't have weekly pays. They didn't have any kind of, they didn't extrapolate it to, bi-weekly pays or mid-month, anything like that. So I would recommend that whatever pay cycle they're on, you find a way to calculate it onto a weekly basis. Because the FTEs, again, hours paid per week divided by 40. 40 is considered a single one whole FTE. You round the number to the nearest tenth, and it can't exceed 1 FTE. So if you have someone working 45 hours or getting paid for working 50 hours, they still only count as one FTE. You don't get to count them as more than one. Now, another favorable piece they put in here for the application is this simplified FTE method that's new. Under this, it assigns an FTE of 1 for all employees that work 40 hours or more per week, and then an FTE of 0.5 for employees that work less than 40 hours per week. So first of all, it simplifies the calculation. If you, by name, of course, it simplifies it in that, if you have a big group of employees that are all 40 hours, you can count them all as one FTE. And then instead of going through and dividing the hours of all the other employees to figure out exactly, how much of an FTE they represent, anyone under that 40, you can count as 0.5. So this will kind of vary. This will vary business to business as to whether this is advantageous. If maybe you have a large group of employees that are less than 20 hours a week, this could actually boost up your FTE. Whereas if you have some that would fall in, 0.75 FTE, you might be better off just going with default calculation and actually calculating this out by the 40 hours. Owner employees are not included in the FTE calculation. So this is both for pre-COVID period and during your 8-week period. So your owner employees do not impact your FTE count. That's, again, something new from the application that we hadn't seen before. So the actual FTE reduction. So the way that you would calculate this is you look at your covered period or your alternative covered period. You look at the amount of FTE that you had during that time, your 8 weeks, and then you compare that to either the period of February 15th, 19 to June 30th, 19, or to January 1st, 19 to February 29th. I'm sorry, January 1st, 20 to February 29th of 20. And the borrower can choose between whichever of those produces a better result. Nothing's new on that. That was still the system beforehand. The percentage decrease in average FTE decreases the amount of forgivable expenses after applying the salary wage reduction. So largely this FTE reduction is unchanged from how everybody had interpreted it. One of the clarifications is that you apply this after the salary wage reduction. So many of the spreadsheets that were out there were either avoiding the salary wage reduction entirely because it was unclear, or I know ours was kind of factoring in that reduction after doing the FTE, but you would do the salary wage reduction first, then do your percentage of FTE decrease. So again, it's a little bit more easily illustrated through an example. Say you have someone, borrower spends $100,000 on forgivable expenses. Through the salary wage reduction calculation that we did over here, they determine that you have a $10,000 reduction. And then the borrower had 30 FTE during the 8-week period and 50 FTE during their reference period. So the way you would calculate your forgivable amount, you paid $100,000 of expenses, you back off your $10,000 of salary wage reduction. That gives you $90,000. And then you did 30 during your 8 weeks divided by 50, your reference period. So you have 60% of the workforce, 60% of 90,000, 54. And that gives you your forgivable amount. Again, as we saw before, there was the safe harbor to avoid the salary wage reduction. And there is also a safe harbor for the FTE. So if you're able to meet both of those, then you won't have to run into that. So we'll get into that FTE safe harbor in just a second. Before we jump into the FTE safe harbor, there is also an FTE reduction exception. This was something that we saw, I believe it was through an FAQ that came out recently that said any positions for which the borrower made a good faith written offer to rehire an employee during the covered or alternative covered period will not impact the FTE count of the borrower. So the way that this actually applies in the application, if you look here, it has this FTE reduction exceptions in this box. So basically what it does is if you had someone where you had the written offer for them to come back and they decline it, that reduces your FTE you get to then take that amount and put it in this box. So you get to restore your FTE by the amount of those employees that didn't want to come back. In addition to the written offer for employees that don't want to return, the application expands this to also include an exception for employees that were fired for cause, voluntarily resigned, or voluntarily requested and received a reduction of their hours. So if you have a reduction in FTE for any of these reasons, you can also, again, on the application, you'll be able to restore your FTE count. Basically what they're doing here is they're just saying, you tried to hire them back, or this had nothing to do with COVID, you had to let them go, or they voluntarily resign. We're not gonna ding you for that. You can restore that amount of your FTE. The only kind of caveat is that in all these cases, the exception only applies if the position was not filled by a new employee. This might be kind of a case-by-case situation as to, if you fired someone and you hired someone else, was it to fill that position, or were you filling a separate position? You might have to look at, job descriptions. Was it a one-for-one trade per se? The whole idea here is they just don't want you, counting the person that was fired and counting the person that was hired in their spot. They don't want you double counting the FTE. So then the FTE reduction safe harbor. So this is the one that safe harbor allows you to completely skate by this FTE reduction to your forgiveness amount. So the FTE reduction does not apply for any borrower that meets this. Again, 2 conditions. You have to have an FTE decrease between those same dates, the February 15th to April 26th. And then your average FTE as of, again, we're looking at a cliff effect here, as of June 30th, 20 is equal to or greater than the average FTE during the pay period inclusive of February 15th of 20. The language might seem a little weird there. Again, I'm pulling this right from the application. Somewhat like the salary wage. This is saying that, regardless of how many people you had to let go, and even if your 8-week period ends before June 30th, as long as by June 30th, you get your FTE count back up to where it was on February 15th, then you're good to go. You have no reduction to your forgiveness amount. I'd like to add, just like I did for the salary one, that just like that, it seems a little odd that you'd be able to just cut everyone through your whole period, not hire anybody back, and then just wait until the last week of June, bring them back in, and you're fine. You can receive full forgiveness. As odd as that sounds, that's how it seems to read through the application. It seems to be a cliff effect of, as long as it's the same or more on June 30th within that pay period as it was during February 15th, then you're good. I mean, of course, if you were to not hire anybody back through that 8-week period, you probably wouldn't pay enough payroll in order to get 100% forgiveness. So it's probably not advisable regardless, because you want to use and get as much of these funds forgiven as possible. But it is good to have this June 30th safe harbor in the back pocket. Absent any other guidance, it seems like it's a hard, fast June 30th cut. Additionally, and this comes from on the application itself. Let's see if there's this line here that basically says, additionally, any borrower that has not reduced the number of employees or average paid hours between January 1st of 20 and the end of the covered period is considered to meet the safe harbor. So this kind of, on top of allowing you to compare June 30th, 20 to February 15th of 20, you can also compare the end of your covered period to January 1st. So if you restore February 15th by June 30th, it appears that you're good, no reduction. And if you restore your January 1st by the end of your 8-week period, it also seems like you're good. Again, it seems to go against the whole, spirit of the loan program for, keeping everyone on payroll and kind of taking a relief off the unemployment system, et cetera. But there have been plenty of employers that have had difficulty getting employees back. So it may end up just being this hard, fast rule of, as long as by these end dates you restore everything, then you won't have any reduction. So that takes That's, a bulk of it is on those payroll costs and the FTE and everything like that. Then you get to your non-payroll costs, these being the mortgage interest, rent and lease expense, and utility expense. For mortgage interest, it's payments of interest, not including any prepayments on any business mortgage obligation on real or personal property. Now, I incurred before February 15th. Now, I just want to point out that these examples here, these, e.g. the examples for each of these three, these come straight out of one of the interim final rules, one of the pieces of guidance that's been put out on the PPP program. If you were to, despite having real or personal property in the definition of mortgage interest, if you were to ask me offhand, I wouldn't define a mortgage as the interest on an auto loan for a vehicle you use to perform your business. But as it's written in that final rule, that was, how they expanded it. Similarly, for utility expense, we've had the question of what's transportation expense, and they say the gas you use driving your business vehicle, or maybe that's what they meant for gas. Typically, I would never say that gas for driving a business vehicle is a utility. But as it's currently defined in the guidance, these examples in the parentheses are the only expansive definition. So we've had questions too on like telephone expense. Is that, can I expense my whole cell phone costs, for example? That we don't have. As far as, definitions, it's these right here. So these are the non-payroll costs that you can spend in addition to your payroll. Each of these, again, you have to be entered into before February 15th. Similar to how they help define the whole question of paid or incurred for payroll costs in the 8-week period, they touched on non-payroll costs, saying that they must be either paid during the period or they must be incurred during the period and paid on or before the next regular billing date. So this, again, seems to lend to the idea that if, say you got your loan on, the beginning of April and you were paying a utility bill that carried over from March, as long as it's paid in the covered period, it appears that that's fine to include that. Similarly, if you incur an expense during your 8-week period, but maybe you don't pay it until the week after it is ended, you also get to include that as part of your forgivable costs. So that's another borrower-friendly kind of expansive definition of the type of cost you can use. One thing is, as I was saying before, that alternative covered period where you can kind of align your expenses with your actual payroll period, that's only for payroll and FTE. For any of these non-payroll costs, you have to stick to the 8-week period starting on the day that your loan was dispersed. There was a lot of confusion on the 75% rule for payroll. We were seeing, I don't know if it was from statements from the bank or applications from the bank, some of them even saying that if you didn't spend at least 75% of your loan on payroll, you couldn't get any loan forgiveness, for example. That's been, for lack of a better word, debunked with this application. The way it works is that no less than 75% of your total forgivable expenses may be on payroll costs. So you don't have to spend 75% of your total loan on payroll costs. That being said, if you want 100% of your loan to be forgiven, you would have to. But again, illustrated with an example here, I'll show you that if you pay less, if you pay 60% of your loan proceeds on payroll costs, you can still get partial forgiveness. It's not a hard and fast, if you don't spend 75% of the loan, then you're out. So in the example, say you take a loan of 100,000, you spend 60% of that, or 60,000 on payroll costs. The borrower's maximum amount that can be forgiven is 80,000. And that's calculated as, you take your 60,000 of payroll divided by 75%. So 75% of 80,000 is 60. So that means the borrower may therefore pay up to 20,000 or 25% non-payroll costs. So in this situation, this is showing someone that had a loan for 100,000, even though they only use 60% on payroll costs, they can still get up to 80,000 of that forgiven. Just that other 20,000 piece, that would be subject to repayment. But it is definitely I'd say a borrower-friendly way to read that instead of just saying hard fast, 75% or nothing. And then the application does have, you can grab these from our presentation, but it's also pretty clearly outlined on here, documents that each borrower must submit. I'll just briefly run through this too. On the payroll side, bank account statements or payroll reports, tax reports, they talk about Form 941 or any state filings, payment receipts, canceled checks, account statements, etc. This is kind of, again, as we've been saying all along, when you go to apply for forgiveness, which, as I mentioned it, as far as I can tell, I don't think there's any actual hard date as to when you have to apply yet. I would think that with all of these June 30th exceptions that I would expect it to be after June 30th, but they've yet to come out and say it must be within 15 days of the end of your covered period, for example. But again, looking at the June 30th, I would expect it to be sometime after that would make most sense if they're going to be looking at that safe harbor. But yeah, getting back to the documentation, when you go to apply for that, you're going to be sending this application to the lender itself. So the bank is going to want, or the lender is going to want, any of these items to substantiate your payroll costs. For the FTE count documentation, that'll show the average FTE has to match the period that you use on the application, obviously, for consistency. And then they kind of reiterate some of the documents that you can include. Also include unemployment tax filings. For non-payroll costs, they outline the items that you can use to substantiate these. So, amortization schedule or the account statement for the mortgage. They want the lease agreement. The lease has to be dated in effect before February 15th of 2020. Utility expense, you'll probably be looking for invoices, the canceled checks that have been written out on those. They also list some items on the application that you should retain. Basically, they're just saying, retain all pieces of the application. There's a worksheet in the application that you use to figure some of your costs. That doesn't necessarily have to be submitted when you submit to the lender, but you'll want to retain it for your records. Even if the application didn't say to do it, it would be good practice to do so. They do say that you should retain for at least 6 years, subject to inspection by the Inspector General, SBA Inspector General, that you should hold on to the application, anything supporting the borrower certification. So that's where, when we talked at the beginning of the presentation about, you want to, even if you find that FAQ and you print that out, you say, okay, my loan's 500,000. I got this FAQ that says if I'm under 2 million, I'm good to go. And then on top of that, maybe you have a brief write-up saying, due to my state, we had to close the lobby for our business, and it reduced the revenues, or the supplier was not available, so we were not able to sell our product, something like that. Even just like a brief memo along with the FAQ that you can use to substantiate why you felt that it was necessary for you to take the PPP loan. Documentation to support the forgiveness, which is everything that they've been mentioning before, and then material compliance with the PPP, which I think if you have all those supporting items, if you have the application in hand, you'll just want to review the certifications on the application itself. Outside of that, I think if you follow all those pieces, then you'll be, in all senses, material compliant with the PPP program. And jump into the future changes in just 1 second. So as I mentioned, there's going to be some type of interim final rule or regulations on forgiveness is coming out. When they released the application, they explicitly said that there's more guidance coming. The HEROES Act, which passed at the end of last week, which will likely not pass in its current form, that extended the covered period beyond 8 weeks. It removed the 75% payroll requirement. It allowed borrowers to continue to defer Social Security taxes even after they get loan forgiveness. It changed the repayment term to 5 years. We saw another bill that increase the period from 8 to 12 weeks. I think there's also another one out there from 8 to 24 weeks. So I know it's frustrating kind of navigating the waters of this program when the rules to the game keep constantly changing. I think the best thing to do is, just follow the rules as they currently stand and adjust for any future guidance as it becomes available. Because I'd be hard pressed to rely on one of these pending changes. Maybe the 12 weeks would really help you out, and it would be great if we could get you the 12 weeks. But you don't want to, reach week 8 and find that that's not going to pass, and you should have been spending more during the previous weeks, for example. We're definitely looking at the forgiven expenses, or the deductibility of the expenses as well. So the CARES Act explicitly said that the forgiven amount is not taxable income. The forgiven loan is not taxable income, but it was not clear on whether the expenses paid with those forgiven funds were deductible. The IRS came out, said that no, you cannot deduct those expenses. However, I think I mentioned earlier, a few members of Congress, they wrote a letter. There's a bill out there to get deductible expenses back. However, we've also seen Kevin Brady came and said, if this was the intent of Congress, then we would have put it in the CARES Act in the first place. So there's going to be a little bit of back and forth on that. Maybe this will come through another stimulus relief package. All right. And give me 1 second. I'm just going to pull up an example from our spreadsheet on the loan forgiveness. And I do want to jump through the application, at least briefly with you, just so you have an idea on what you're looking for. And just kind of as a caveat while I'm waiting for that to load up. There it is. We are going to be assisting with the forgiveness. So if you're someone that's already been using another spreadsheet, or you've been using one of our previous spreadsheets, like I said, we'll have the new spreadsheet available for download if you want to give that a shot. If you want to reach out to us, we can take that info, convert it into the new one, see how the forgiveness measures up to how it was before. And then, of course, general questions, et cetera, will be available to answer those for you. But definitely, don't hesitate to reach out. We're going to be helping out calculating the forgiveness on a lot of these loans. And just before I do dive into that example too, I just wanted to reiterate as well that these are all kind of proposals. So as I was saying, don't hang your hat on any of these future changes per se until they come to fruition. All right, so we got the example here. So I'm going to be kind of jumping back and forth. Let me just do a quick run through on the application first. So the application kind of gives you some definitions and instructions. Here's the actual application piece itself. This is where you would calculate your forgiveness amount. Here are the actual borrower certifications that you have to make, that you're attesting to when you sign. This is Schedule A, which you would use largely to calculate your FTE and your payroll costs. And then you've got your Schedule A worksheets, which is the employee by employee calculation of your cash compensation and your FTE and your hourly wage reduction. You've got the safe harbor calculation for FTEs right here. And the last page of it also has this optional demographic information. This was part of something that was in the CARES Act for them to collect. So that's on the application itself too. But to dive into the example of it, so I'll go piece by piece. So we got borrower obtains a PPP loan of 80,000 on April 10th of 20. Example, borrower, 80,000 loan on April 10th. Borrower has 4 employees, A, B, C, and D being the owner. 2019 compensation. So you have to remember where you have to decide which table the employees are going to fit in based on whether or not they were at that 100,000. So employee A was 50,000 in 19, B 90, C 110, D 150. And then they also laid off employee A on April 1st. So employee A does not make it into the worksheet because they were laid off. They weren't paid during the 8-week period. Employee B, they were under 100,000, so they're in this top section. And employee C was over 100,000, so they make it into table 2. And employee D is an owner, so that kind of goes in its own little section itself. As I said, due to COVID-19, the borrower laid off the employee on April 1st of 20, so that's why A is out. Now here's a bit of the calculation. So during the 8-week period, the hours stayed the same. B, C, and D were all working 40 hours or getting paid for working 40 hours a week. C and D, if you annualize these out, it comes out about the same. So we'll say C and D had no pay cut, but employee B, their salary was cut from 90,000 to 60,000 on April 1st of 20. So you think 90 to 60, okay, so now you have to determine whether or not you have one of the salary reduction adjustments. So you would go here, and this worksheet, this comes, kind of copied and pasted right out of the application. You would go, this is the calculation for employee B. You go in, you say that they're salaried. They made 60,000 during your 8-week period. They were making 90 before. Here you look at, so now you have to determine whether, so first you look at the 60 to 90, that was over a 25% decrease. So you know that you may be subject to the reduction. Then you go to the safe harbor step. You were making 90,000 on February 15th. There was a decrease to an average of about 80,000 between February and April. And then as of June 30th, they never raised the payback. You're still making 60,000. So you never restored your salary back up to the 90,000 by June 30th. So no safe harbor. So now you have to actually calculate your reduction. You look at 67.5 is 75% of the 90,000. Difference is the 7,500. Divide that by weekly, prorate that over your 8-week period, and you've got an adjustment of 1154. So this would go right on your spreadsheet. Salary, hourly wage reduction. So we may be updating our spreadsheet in the future to do so, to be able to automate it for all employees. But as it follows the application, you have to do this calculation for each employee. You can keep in mind that if you have someone that didn't get their salary or hourly wage cut by more than 25%, you don't have to do that calculation. So if you kept someone the same pay, you don't even need to really waste your time on this sheet. This reduction is completely not applicable. So that takes us through the pay cut. And then just to touch on, just to show you how this sheet would work. They had other payroll costs, health insurance premiums, retirement, SUTA, non-payroll costs, mortgage, rent, utilities. You enter all that information in here. It runs through the calculations. And then the last piece to take you through, borrower rehires employee A on June 20th. So they were laid off on April 1st. They're hired back on June 20th. So that's where this FTE safe harbor tab comes in. It looks at, you had a decrease between February 15th and April 26th. You restored it to the FTE count that you were at by June 30th. You satisfied the safe harbor. So now you have no decrease related to the FTE. So all the salary and FTE information, this feeds into Schedule A. This calculates payroll costs, your FTE reduction quotient, your safe harbored, so there is none. And then you calculate your forgiveness. And your forgiveness ends up being the lesser of 3 amounts. It's either this modified total of the amounts you spent. So if you look at spent 55,470 less this. So you spent 54,316. Your loan was 80,000. And your payroll cost divided by 75% is 57,000. So you get to forgive 54. 80,000, forgive 54. And then we have an amortization repayment schedule based on the CARES Act text as to what we think it'll probably look like when you go to get repayment. So that takes us through the majority of this information. As for resources, you got a link for the application itself. There's a Treasury PPP guidance page, and that lists out all the different interim final rules. I can show you that quick. So this has, all the information for borrowers, lenders, all the different regulations and everything that's come out. And then we do have this web page. We'll be putting the recorded presentation along with the slide deck and the forgiveness worksheet, that Excel I was just going through. Those will be on that web page shortly. You can contact any of us with your questions. And before we wrap this up, I am going to bring up the Q&A just to see if there's any we can touch on. It looks like we do have quite a few in there. So definitely feel free to reach out to us on this. Let's see. Yep, so how do you calculate FTEs? That was in there. Incurred, paid, I think we touched on that. So if you have employees on biweekly, some monthly, when you're calculating their payroll costs and their FTE, you want to find a way to work that into a weekly calculation. You are not able, if you are more than biweekly. So if you're doing, a monthly pay, you can't use that alternative covered period. But if you're biweekly or weekly, you can use that alternative covered period, which aligns your 8 weeks with your payroll. I think that answers some of those too. Okay. Employer portion of FICA do not get included as part of payroll costs. We did have a question, and this is a good question. So if your workplace is full-time, so if someone working full-time, whether salaried or considered to be working full-time at your workplace, is, the example here is 36 hours, but maybe it's 30 hours, for example, how does that come into play with the 40-hour FTE? I would say that I'd be leaning towards, if they're full-time, consider them one FTE. I'm hoping that there's some type of FAQ or guidance to kind of clarify that, because someone that's been working full-time, if there hasn't been any reduction to their hours, I don't think you shouldn't be getting hit for that. So there's nothing explicitly addressing that for those that have full-time less than 40, but I would think you should be able to count them as a full single FTE. And just to reiterate, I think I touched on it. I just glazed on it. For the FICA match, as far as part of that being a payroll cost, the employer share is not a payroll cost. So you just use your gross wages of the employee. The employer piece of the FICA taxes is not included as part of the payroll costs. And as far as the state and local taxes assessed on wages, you're generally just going to be looking at state unemployment tax as that should be what they're referencing to, the SUTA, state unemployment tax. It wouldn't be the actual state tax withheld from the wages. That being said, any amount withheld is already in gross. So you start with your gross, and then you can add any SUTA. I did want to touch on two. So there's been the question of self-rentals that has not been addressed. As of now, it still seems open that if there's a lease in place, it seems like it's okay to be included as part of rent expense. There hasn't been any mention one way or the other as to whether or not self-rental gets kicked out. I know we have a few of our auto dealers are here as well. There's been the question as to whether auto floor plan interest is forgivable. I don't want to give a hard and fast yes or no on this. We're definitely we're definitely looking into it and seeing some other interpretations as well. Would you consider, inventory secured as a mortgage on personal property? I can see some argument both ways there. I think at first we were leaning on that additional provision in the CARES Act that said you could deduct interest on other debt incurred before February 15th. I think if that made it into the forgiveness piece, that we'd be fine to use the floor plan. But since we're just leaning on the mortgage definition, I'm not sure that I'm still, it's still unclear as to how we can approach the floor plan. All right. There's definitely plenty more questions to go. It would take a bit to answer all of those. So please, if I didn't get to your question, reach out to one of us and we can address that for you. We're here to help with the forgiveness. Check our website for all these resources, and look forward to seeing you next time when the next piece of information comes out. We may be doing some more webinars too. So enjoy the rest of your day, and thanks for attending.